Thank you all for being here, Upgrade Partners Capital. Michael, why don't you give us a quick intro of yourself, and then I'll intro Brandon and Christine, and we'll go from there.
Hey everyone, I'm Michael Mahoney. I'm the CEO of Upgrade and one of the founding members of Upgrade Partners Capital. And I know many of you have been on calls with us before. Some of you, it is your first time. Excited for everyone who's here and everyone's going to watch the recording as well. We're more excited because we have on with us today two people that I've gotten to know, one of them very well and one of them get to know him. The first is Baudry. He is going to be talking about Avestor. And Avestor is a very, very unique platform that is going to be sponsoring and helping the UPC in our new customizable fund avenue. We've just gotten to know about the strategy over the past few months. I think it's a very, very unique and intelligent strategy for us. It allows us to diversify and give our investors options to diversify as well. So I'm going to let Baudry talk about that more. Devin Johnson has become a very good friend, and she's going to speak today about her mastermind that she is a part of, as well as some opportunities that you guys could consider jumping into. I know that she's one of the most highly unique human beings I've ever met, along with being a very, very savvy investor. So I'm excited that she's here. Anyone who does not know me well, feel free to my contact information. We're all that's part of UPC Fund. We're all available. We're not the biggest fund out there, but we'll definitely be there to answer the questions. So, Christine, why don't you go ahead and introduce yourself?
Wonderful. Thank you, Michael. And we are so glad that you're all here. I'm Christine Diamond, and I'm the investor relations rep for UPC Upgrade Partners Capital, and have been working a lot behind the scenes with Joe to establish this, to pull everything together. And we have created something beautiful, and it's just going to grow from here. So just really excited to be that rep who is helping you to establish a firm connection with us. And I'm going to be your go-to person, making sure that the onboarding process is wonderful with Avestor, that your wealth goals are taken into account when we present you with deals and opportunities. And I'm just here to help. So really happy to be a part of this.
And really quickly, Brandon and I, who can't be on here, he is in North Carolina. He is the VP of sales for InMode. And he's busy right now just getting that role all figured out. So it's quite a really cool promotion for him. So he's got just as much passion with what we're doing as we do, and with real estate as well. So so Christine talked a little bit about the investor survey. I don't know if she mentioned this, and Christine, if you want to mention it, but there will be a prize drawing at the end for all of those who filled out the survey. So anything else you want to say on that, Christine?
Yeah, so this is a way in which for us to get to know each of you a little bit better, and we would love to follow up with an individual phone call, truly understand your wealth goals. And so we thought, why not have an opportunity for your very first return with the fund? By filling out this survey, you're entered in to win our prize near the end. There will be a little drum roll, and we'll see who gets to win that. So definitely fill it out. Thanks.
And stay to the end. So with Upgrade Partners Capital, what our plan is moving forward is we have structured our fund as a 506c customizable fund that we have built with Baudry. And essentially what this does is it gives you the ability to invest in really any real estate asset class, not just multifamily, even though that will be our main focus. And you would have the ability to invest in different assets within our fund. And Baudry will go into more detail on that. I just want to give you a quick highlight of what we're doing, what our plan is. I would say that by the middle of Q2, we will be deploying our first round of funds, or even sooner. We've already got investment opportunities, and Devin will speak a little bit on that. We're just finishing up our legal work right now, and we'll let you all know when we get that done. And we're really excited about giving you guys the opportunity to invest in some of our vetted sponsors and their deals. So I want to turn the time over to Devin Johnson. Michael gave her a really good introduction. I'll just say really quickly, Devin has become the last 6 months one of my favorite people to talk with. She is truly a visionary. You're a visionary and you are an action taker. And she and one of our original founding members have built a really cool club that she's going to present to you today. We are going to work with her on finding deals and deploying capital. So you know that if you're doing a deal with Devin, with us, that it's going to be a good one. So Devin, the time is yours.
Thank you. Well, nice to meet all of you virtually. I'll give you guys just like super high level background of who I am and why you're listening to this crazy purple haired lady. So I've been an entrepreneur for about 20 years now. I know I don't look quite that old, but I am. Started in the retail business, built a chain of retail stores, sold those, and then with the capital that I had from the exit, bought property to flip it and thought, well, maybe I'll do real estate next. This is fun. So I've worked in many, many different areas in the real estate industry over the last 10 years. I started as a residential agent. I built a property management company, had my own brokerage for that. Sold the property management company. Then I started to work for a residential fund. It was a debt fund, and I got some experience there raising capital, doing a lot of investor relations, investor education, and pretty much throughout my entire real estate career, I focused mostly on investors because I figured out quickly they were repeat buyers, and it made my job a lot easier. So after working with that fund for a couple of years, I broke out on my own and started doing some of my own bigger projects. Raising capital for those, putting teams together is one of my greatest areas of expertise. Being able to look at a project and figure out, okay, like who do we need on the bus in order to make this happen, right? We're going to need debt and equity and project management, being able to identify a lot of those key pieces. So the investment club that my partner and I have started just very recently came out of essentially a lot of relationships that have been built over the last 10, 15 years. I constantly have people reaching out to me saying, hey, can you raise capital for this? Can you raise capital for that? Or what should I do with my money? What should I invest in? I think I want to do Airbnbs. I think I want to do multifamily. And what I've learned is that a lot of investors, they don't really know what they want. They may have an idea of a type of return that they want. They may have an idea of a particular asset class that appeals to them, but that's not necessarily the vehicle that's always going to get them what they want. And my partner has a similar situation going on where he's a partner in a consultancy that helps people launch and scale investment funds and has a ton of deal flow come across the desk as well. So we're constantly seeing tons and tons of opportunities cross our desks, and I realistically raise capital for all of these deals, but a lot of them are really, really good opportunities and we're underwriting them. So what we've done is we've founded a club, essentially a mastermind, where we're sharing one deal a week where we have done all of the due diligence. Now, our deal flow is not just real estate, which is one of the things that makes us pretty unique. We have opportunities for, medical tech startups, e-commerce businesses for sale, e-commerce roll-ups, and then real estate across a number of asset classes, from small individual projects to huge developments. So that's basically what we're offering for the members of our club, and our mastermind is this huge, diversified. It's like a buffet of investment opportunities. And on a weekly call, what we're doing is we're breaking down each one of the deals. going through the due diligence that we do before we share these opportunities to decide, you know, is this something we would take a look at or not? So we're weeding down about 100 deals that we see a month down to about 4 or 5, and therefore, you know, only passing on the cream of the crop, and at the same time educating these investors about the different opportunities, the different asset classes, so they can start to decide what makes the most sense for them depending on their goal, their wealth goals, their risk profile. For example, we recently shared an investment into a cannabis company, which obviously is not a fit for UPC being a real estate fund, but for an investor that has an appetite for risk capital, you know, it was mitigated risk in an asset class that they may not get exposure to. This opportunity came to us through a very strategic relationship. So that opportunity, it's not available to anybody else. We negotiated preferred terms, and because of the relationships that we've built over decades, oftentimes we're able to get those types of opportunities. And I was so excited when I started chatting with Joe about it to see that there's an opportunity there with what we're already doing to kind of weed down some of the opportunities that UPC fund will be looking at to potentially invest in and offer their investors. So a couple of the real estate opportunities that we have shared very recently. One is an RV park, an RV storage development that is in California. The sponsors of that deal do have control of the land, and they're turning raw land into this RV park and RV storage. There is a considerable amount of equity being built with just the entitlements being done. The $1 million parcel is immediately valued at $4 million, and we have third-party validation from an outside appraiser. It's not just like some dude saying, yo, this is what my project is going to be worth. We're collecting third-party data and verifying all of these assumptions that the deal sponsors are sharing with us. That particular opportunity has a really unique structure as well, and that they're planning a refi on about 6 months in, and will give investors 80% return of 80% return of capital within their projection is 6 months. So what we do also is we stress test their pro forma and say, okay, cool. What if it takes a year for that refi to happen? What impact does that have on the investor returns? So for somebody like Joe, who's looking at what opportunities UPC fund may potentially invest in, he's got a couple other sets of eyes whittling down some of those opportunities before he considers them. And with that RV park, so 80% return of capital within 6 months to a year, and then essentially it's almost an infinite return because the investors will have 100% return of capital by year 3, and they're not planning on an exit for probably 10 or 15 years. So that's a very, very long time to have consistent cash flow while you're, you know, basically pulling your chips off the table pretty early on into the game. Another one of the real estate opportunities that we shared recently is self-storage, which is a very hot asset class. I'm a big fan of self-storage for many reasons. There's low maintenance costs. You don't need nearly the amount of staff and overhead as you might for, you know, say a multifamily or some other single family. Single family is a lot of work, which I know, having worked for a single family fund. So with this self-storage development, it's going to be constructed in Georgia. It is ground up construction. No, it's not. That one's a rehab and they're adding additional units. Sorry. So that one is a value add, and it's in a very underserved market. And there is cash flow on that deal from day one, and the sponsors will be paying distributions monthly, which I think is incredible. You know, anything that you can do for an investor to start getting some return into their hands as soon as possible is really favorable. And also helps to mitigate risk when in a fund of funds, type scenario, or when you're investing in multiple different asset classes, if you've got some of those land development type plays that might have a huge upside, but no cash flow for 18 months, the risk can really be mitigated and even out the returns. If you have some other opportunities, they're going to start to cash flow from day one. So that facility is already, it's already producing cash flow. They're going to add quite a few additional units, reduce the operating costs, and it's got around a 17% IRR, planning on an exit right around 5 years. Was that everything you wanted me to say, Joe?
Yeah, that was great. I appreciate it. And, you know, one thing that I love about what you've got going on, one thing that I've realized is extremely important is the vetting process of the deal sponsors and the deals themselves. We want to make sure that we mitigate every single risk possible when we're investing both your money and our money, because we will be investing right alongside you. That's one of our requirements, because we're not going to ask you to do anything that we're not going to do ourselves. And so I'm really excited for what you got and some of your opportunities, and that, you know, the investments that you've shared, you know, are great opportunities. And so that kind of shows everybody on here that is considering investing with us now, you know, that those will be the returns and opportunities that you'll have access to. And then we'll also be bringing other real estate asset classes and, you know, of course, multifamily as well. So really quickly, does anybody have any questions? I'll give you like 2 seconds and then we'll move on to the next. All right. So along with Devin's, and thank you, Devin, for being here. I know it's short notice, but I really appreciate you and your partnership and friendship. You know, Devin's platform gives diversification. And so how do you do that legally? Well, that's where Avestor comes in, is that we can invest in a storage complex of Devin's or of an apartment complex of, you know, maybe Ryan, right? Ryan is a sponsor that we're talking with and want to raise money for, because, you know, he's got about 1,000 units under management. And, you know, so there's going to be a lot of diversification of what investors can invest in. And so, Badri, appreciate you being here and appreciate what you've built, giving the investors the ability to have multiple options of what they can invest in and, you know, be able to do it within a fund model so that it really works for both the investor and the fund manager. So the time is yours, Badri.
Hey, thank you, Joe, for having me over. Appreciate it. If I sound a little stuffed, I am, but fighting a little bit of a cough and cold, you know how that goes.
Yeah.
So let me go ahead and share my screen. If you could, Joe, give me the ability to share my screen. Thank you, sir.
Oh, there, okay, you're good.
All right. Thank you. Thank you. So great job, Devin. I think you have came up with a great series of deals. And now the question is, as Joe said, how do you go about actually investing in those deals and tying it all together in a structure which is comfortable from an investor perspective and is legal and handles all the accounting and everything else. So, good afternoon, everyone. Good evening, wherever you are. My name is Badri Malinor. I'm a co-founder of Avestor. Some standard legal language which our attorneys ask me to include in every presentation. You should not think of this as official investment advice, and you should consult your own investment advisor. Real estate does have a certain amount of risk, like any other investment, and you should do your due diligence before investing in anything. And I'm sure Joe would agree with me on that. So very briefly, before I go into the mechanics of various things, just briefly, some background about myself. I was an exec in a Fortune 500 company, retired almost 15, 20 years back until my co-founder came up with this idea for Avestor, and I said, I have to build this billion-dollar company. I'm a Ducks fan, went to University of Oregon, live in Portland, Oregon. I love to travel. My goal is to visit every country in the world. I'm up to about 70 countries. Still another 120 to go, quite a bit. And I ran a hedge fund involving index trading options. I love to ski, love to hike. I've invested in 35 different startups. I invest in crypto, real estate, all sub-asset classes in real estate. So I can speak from a variety of experiences as far as investment is concerned, So having said that, let's kind of get into some of the core of the presentation. All of you kind of know how to build a stock portfolio. And, you can go to advisors and maybe you can build a bond portfolio. But how do you go about building a real estate portfolio? I'm not talking about a single deal or investing in a syndication here and a syndication there. How do you build a holistic portfolio? I'm not necessarily talking to the Bill Gates of the world who has $1 billion and he can sprinkle in multiple states. But people with lesser amounts of money, if you want to invest in multiple asset classes and multiple geographies, how do you go about doing that? So the way it works, we have a platform where the fund manager identifies all the investments like Joe, and he partners with people like Christine and others. And the investments are fractionalized, and all the due diligence is done by the fund manager, and people can come in and pick and choose which deals they want and how much they want to invest. So one of the advantages of the fund of funds model is the amount per deal would be a lot lower than if you were to go directly into the deal. The investors join the fund, and then you pick these slices. And the nice thing about this fund of funds model is when a deal exits, or maybe you get some returns or distributions, you can choose to withdraw the money or you can reinvest in the deals. We have something called a virtual cash balance, which allows you to reinvest in each of the deals, So, but let's step back a little bit. Building a real estate portfolio is really hard. How do you go from the left-hand side to the right-hand side? Wall Street has really done a number on us where, they say, put all your money in stocks and bonds and maybe put a little bit in cash. But we want to go to the right side where you want to build some alternative investments, maybe real estate, maybe non-real estate, like Devin said. Finding opportunities, the deal structures are complex, you have significant capital requirements, you have to manage the risk. And the bottom line is, you have not made money until you have made money. You can invest in real estate, but until it exits and you have a profitable return, you have not really made money, right? So what are the different ways you can invest in real estate? The most common is investing in individual properties. It has various trade-offs, right? You have your single market risk, and most people try to buy properties very close to where they live, and there is really absolutely no diversification. And there is the famous midnight toilet problem. Yes, you could hire a property manager, but do you really want to go through the hassle of managing a property? You could invest in private real estate investment trusts or funds. The common fund, unlike the customizable funds provided by a investor, does not give you a choice. It's like going to a Fidelity and saying, I like this fund, but I don't like this 10 different stocks. Can I invest in this 20 different stocks and not the 10 stocks? A lot of the real estate investment trusts and funds do not give you that flexibility, whereas a customizable fund does. You can invest in syndication deals, which is absolutely a great thing to do, but there are several problems with that. And in fact, I think the fund which Joe has created will allow you to invest in syndication deals. You have to do a lot of due diligence on the deals. You have to have the time to decide which deal is a good deal. And some of the really good deals go really fast. And also minimum investment for these deals are like 50, 100,000, maybe 25,000. But you really cannot build a diversified portfolio unless you have at least $1 million. Or you can invest in real estate loans, which is a great way to add steady income to your portfolio. So what are some of the things you should consider when you build a real estate portfolio? When you start building a real estate portfolio, think of it like building a jigsaw puzzle. Yes, I don't want you to get paralyzed about thinking, what is the first piece of puzzle? Then you'll never start the jigsaw puzzle saying, should I start with this piece or should I start with this piece or this piece? Do have a plan in place, but don't necessarily think of this as a long-term journey where you're putting together pieces in place and have an overall plan and start adding pieces to the jigsaw puzzle, right? Here are some of the things you have to consider. You have to think of the portfolio structure, and I'll go into a little more detail in each of these dimensions. You have to think of the fact that you're diversified. How do you go about selecting a deal? Do you have adequate cash flow, as Devin said? I mean, it's great to have deals where you're getting cash flow from, if not day one, at least in the first year or so. Do you have multiple liquidity points, and are you maximizing tax benefits? Let's take a look at each one of these elements. When you build what I mean by a portfolio structure is, let's say you have, I don't know, $200,000 you want to invest in real estate. How do you divide it up? I mean, obviously you could buy 2 single-family houses at $100K cash and take some debt, or maybe you could buy five private funds at $50K each, or maybe you invest in 8 syndication deals at $25K each, or maybe you do $5,000 each and do 40 loans. But how about if you're able to do a mix? But the basic point here is you want to transition from what property do I buy to how do I build a long-term real estate portfolio that balances risk and returns. You again take that long-term perspective, even if you're doing it one piece at a time, right? So, and you want to diversify across multiple markets. Just like a stock portfolio, diversification is very, very critical. If you look at a market like Boston, Portland, and Durham in the last few years, markets zig and zag. Yes, there is some common thread in all the markets, but sometimes the market is really hot and it kind of cools down, and different markets peak at different times. You really want to invest in multiple markets. Now, I'm sure the question which pops into your mind is, how do I do that if I have limited amounts of money? And that's where Joe and his customizable fund comes in, really. You want to diversify across multiple asset classes. You want to do some new construction, which is a little higher risk, but gives you a higher return. Maybe you want to do some value add. And definitely some of the asset classes which are already discussed: multifamily, single family, built to rent, retail, mixed use, self-storage. And you want to kind of build a mix based on your own needs. I'm sure Joe and Christine and his team are happy to advise you and consult with you, but ultimately you have to make a decision as to how you want to build this portfolio, right? So, and deal selection, it's a complex process, right? I mean, for a single property, you have to look at property specifics, debt servicing risk, renter risk. For real estate loans, you want to look at borrower risk, and are you investing in states where there is foreclosure flexibility, right? You don't want to invest in states which are extremely tenant friendly. You'll never get your money back. And then when you're looking at syndication deals, you have to look at the track record of the sponsor, the track record of the deal, and the capital stack risk. I know Joe will do a fantastic job in analyzing these deals along with his partners. At Evester, we have various tools which we provide to make sure that that helps with the due diligence process. Yeah. So you also then want to look at your cash flow needs, right? I mean, if you purchase a rental property, you have periodic income and you have loan payments, and ultimately, hopefully, you pay your money, pay your house loan back, and you get some appreciation. If you do a debt deal, you get periodic monthly interest. Or if you do an equity deal, depending on the deal, there is generally none or limited distributions, though value add deals do have some distributions right from day one. And most of the distributions come in later years, and a lot of the money you get is when the deal finally exits. And that's what contributes to something called the internal rate of return, which we can go into more detail in another future seminar potentially. You also want to look at multiple points of liquidity. You want to build a portfolio which has multiple points of liquidity. You know, life can throw a curve at you. You think you've got it all together, you think you've got your act together, but you never know, right? So you want to invest in different deals, maybe a deal which exists in 3 years, maybe a deal which exists in 5 years or 7 years. You want to have multiple points of liquidity where you can go back and reinvest that money if things are going on plan. But if they don't, at least you have the ability to withdraw the money, you know? So, and then you want to look at tax implications, right? Real estate loans, generally you get a 1099 INT. For syndication deals, you get something called a partnership K1. And then for private REITs and funds, you get a 1099 div. One of the nice things about the customizable fund platform is even if you invest in 10 or 15 or 20 different deals, you get a single K1. That is huge. We have literally spent hundreds of thousands of dollars on this feature. and our investors absolutely love it. Frankly, if you like getting 10K once at tax time, well, you're either a masochist or you're a tax accountant. I mean, hey, pile on the K1s, give me 20 K1s and increase my fee, right? So, and the single K1 has other benefits too. You can continuously offset depreciation, gains from one investment with depreciations from another investment. This is another benefit of the customizable fund, right? So what Avestor is an online platform where investors will partner with experts like Joe who can create their own fund. We provide all the tools for them to create the fund as opposed to asking them to go shop around accounting, legal, taxes. We have done all the legwork, and think of it like bringing the stock brokerage type of experience to real estate investing. So Joe, he's really effectively bringing now I don't want to insult your favorite stock brokerage, TD Ameritrade or Morgan Stanley or whoever it is, type of experience for his own investors and investments, where investors can pick and choose how much they want to invest and how much they want to, which deals they want to select, right? So he does he partnering with other partners, and we also give a stream of deals which Joe can evaluate and see if it's a fit for his investors. He does all the deals research and selection. You still do the final selection, but wouldn't you rather have someone look at 100 deals and give you 4 deals to select from than you wade through 100 deals? That's kind of the value which UPC fund provides, and it's completely customizable. It's not a one size fits all blind fund. You get to pick and choose. Maybe you already make enough money. You're not looking for cash flow. Then maybe you do more new construction deals. Or maybe you need some cash flow. Your job is not, maybe not the most steady right now. And so then maybe you do value add, or maybe you go for debt deals. You can invest in different states, different horizons, time horizons. Maybe some have exit of 2 years, some have exit of 6 years, some have exit of 5 years. You can invest in different asset classes. And it's all very, very transparent. It's not you taking Joe's or Christine's word for it. Oh, trust me, the fund is doing this, but we can't tell you exactly how it breaks down. You can actually log in and see deal by deal how each deal is doing. Just like you would log into a stock brokerage account and see how each stock is doing. You'll not only see how the overall fund performance is doing, but you'll see how each deal is doing. And you have the liquidity to withdraw the money if there is some extra cash sitting in the account. Again, go back to the stock brokerage analogy, right? If you have you sell a stock and you have some money, you have the ability to withdraw the money, or we provide unlimited ACH capability. You can link your bank account to the Joe's fund, or maybe Joe and Christine will offer another deal saying, hey, Devin, you have $20,000 sitting in the account. We have this other deal coming in. Do you want to invest in it, right? And then all of this is packaged in one extremely tax-efficient structure, because unlike blind funds, where some of the depreciation benefits may not flow through, 100% of the depreciation benefits flow through on a pro rata basis, of course. If for $1 million investment, if you invest 100,000, obviously you'll get 10%. You're not going to get the entire $1 million worth of depreciation. And all of this is packaged in a single K1. And like as I indicated, our investors really love that feature. Yeah. So here is a sample example, of what an investor portfolio can look like. You invest in multiple markets. You're investing in different time horizons. You're investing in single family, multifamily, self-storage. This is just a hypothetical example. You're putting $500 or $1,000 in various debt deals, and then you're putting the $5,000 in this Winston Hill apartments or Boston student housing. Now, this is just, again, to reiterate a hypothetical example. Joe might have different minimums for different deals. Maybe it's higher than 5,000 or 10,000 or 25,000. So, but it depends on the deal and so on. Yeah. But different time horizons, different asset classes, different geographies. So generally, the type of deals which are available in these funds are syndication deals. We won't go into too much detail. I'm sure Joe has talked about syndication deals before. You're getting an actual stake in a commercial property, 3 to 5 years. It could be value add or new construction. And you get a pro rata share of the income distributions and pro rata share of profits. I know Joe will focus on some of the lower risk categories and offer maybe higher risk categories as an option if you want to invest. Or it could be real estate loans also, where you get a slice of a loan. We are happy to work with Joe, and he can work with operators or work with other fund managers on the Avestor platform who offer these loans and you effectively have the first mortgage liens, and you can get 8 to 14% interest, and relatively low risk. And even though the interest rates have gone up, they've not gone up that much. You're getting much higher returns here. Yeah. So it's all bundled in a nice online portal. When you log in, you'll see the investor dashboard, just like you'll be able to log into a stock brokerage account. You'll see the account balance. You'll see the number of deals, return on deals. And then Joe and his team can build custom portfolios for you based on what you're looking at. There is a geographic map where you can click on anything to get additional information. And or you can get a detailed investment by investment view. So it's very, very transparent. Unlike a blind fund where there's a lot of behind the scenes wizardry going on, you can see exactly how much you have made in each deal and what the returns are. So that's kind of what I had, Joe. We believe a customizable fund is the future of investing, not only from a sponsor perspective, more importantly, from an investor perspective. We didn't build this platform for sponsors first. We built this platform for investors first to make it tax efficient and very investor friendly. And then we offered it to sponsors. So yeah. I think Joe seems to have a great fund going. We are happy to partner with him, and I appreciate the opportunity here. Thanks, guys.
Thank you so much, Badri. Really appreciate it. I'm quite excited about working with you and on this structure. One thing that just came to my mind, as you know, your screenshot there of the last screen, is the ability that if an investor wanted to, they could go and say like, hey, I've got 50K, I want to invest. Where do I put it? Oh, I can just go on my portal and I can look at Devin's deal that she's got, or this other multifamily deal. Oh, I'll just invest 50K. It's going to be like that simple.
Exactly. They get to choose how much they want to invest in which deal. Exactly.
Yeah. So we're making this process as easy as possible. We'll have the due diligence items with that deal, and it's fantastic. And I love the risk mitigation that you guys have built for this. I love the fact that if an investor invests in 3-4 different deals, you get 1K1. That is huge. So I did have one question come up. Is it possible for investors to 1031 into our fund with you?
Unfortunately, no. And that is not a limitation of the platform. Yeah, sure, Joe, no problem. Oh, wait, it's not legal. You can't do that. So a 1031 has to be a like exchange into a physical property. But having said that, Joe, there are ways we can work together where if the 1031 investment is large enough, it can come in as a JV type of a relationship. Yeah. So Devin has a deal and she's willing to take 1031. The UPC fund can be one investor, and the investor can come in directly at the syndication deal level. We can talk about those structures, but you cannot come in through a fund of funds for legal reasons.
Got it. And I'll need to dig into this more, but I guess one question on that is, I guess depends maybe on the investment amount, but could they do a DST? And I guess that may be what you're talking about with the JV, right?
Exactly. So they can bring in a parallel to the fund, but they cannot come in through the fund.
Got it. Okay. That makes sense. And that's something that we would have to do with our legal team. So yeah, it is possible.
1031, you also want to make sure that it's a large enough amount. If you're putting $20,000 in a 1031, the overhead is more than.
Yeah. So you'd want to be 100K plus most likely for it to make financial sense, because there is additional costs. Okay. Does anybody have any questions for myself, for Devin, for Badri?
Or also what specific things stood out to you that you'd like to highlight? Because I know sometimes when we ask any questions, it might make you go deer in the headlights. But if you have had written any notes from the conversation today and something stood out to you, we'd love to hear that too.
Of course. While people are thinking about their question, I'm going to share my screen quickly, and then Christine, if you want to pick a winner for the survey. Can you guys see my screen? No. Okay. So as a call to action, we will be reaching out, and I apologize, Christine, I don't have yours, but it's just Christine at UPC Fund. Take a screenshot of this. Reach out to us if you have any thoughts, questions. We'll also be reaching out. One thing that I wanted to bring up really quickly is that when we're investing, we are building our wealth. We're quite blessed to be able to be doing what we're doing and have the resources, the financial resources, and whatever else that we have in our life. We believe strongly as part of our organization to give back. And so I have a nonprofit that I've created that I'm very passionate about. And so part of our fund is that we are going to take a percentage of our proceeds that we will make and donate it back to my nonprofit, but others as well. So we believe in that when we make money and you make money, that there is a lot of energy behind that. And to keep that energy flowing and to maximize it, that by giving back and helping others in their state of need, can really maximize that energy. And what goes around comes around. And so if you're giving, that it can be huge for you as well. So Tiny's Tribe, really quick, is what we do is we find local families in our local communities that have been in some kind of tragic incident or accident, and we go and support these families with pretty much the three necessities of life, right? That is financial support, housing, and food, right? Those are the three main things that how we like to support families. And then we're also partnering with multiple other service providers to clean a family's home or clean their car or provide, hospice if they need it. Our objective with this is to, help families have an optimistic look on life and help them make life as easy as possible in their time of need. I built this out of, a need for myself. I was in a car accident 10 years ago. And I lost my brother and my grandma, and I would not be who I am today or where I am today if it wasn't for the community that pulled funds together to pay for hospital bills, for funeral costs. And the community literally kept me awake. And I probably lost sleep because of the amount of people that came and, just made sure my family was okay. And I'm eternally grateful for that. So I just wanted to share kind of a passion part of this fund. So, yeah. Okay, now I need to figure out how to stop sharing. Okay, all right, let's see. There might be some questions. No, okay. If there's no questions, Christine?
Yeah, we do have some people who filled it out. So good job, everyone. I'm going to refresh it to see if anyone did since I put that on there again. And out of the people who are still on here, you guys ready for a drum roll? It's Tom. Woohoo!
Congrats, Tom.
Fun. You got your first return.
And what that is a $25 Amazon gift card. So we will be sending that to you here in the next few days. So
fun.
We really appreciate. Oh yeah. Hi, Tom. Good to see you.
That's camera worthy. Thank you.
Yeah, appreciate you being on here.
So fun.
Okay, everybody. We are early. Look at us go. That is being efficient. So appreciate all of you, and we will be reaching out and talking soon. Have a wonderful night.
Bye. Have a good one.